So, the second thing that you need to be familiar with related to materiality before class is tolerable misstatement. So, we talked about overall materiality, which is at the financial statement level, and tolerable misstatement is defined as materiality at the account balance level. So, financial statements are made up of various accounts, right? We have cash, accounts receivable, inventory, we have all of our liability accounts, our revenue and expense accounts, and tolerable misstatement needs to be set at such a level that reduces to an appropriately low level the probability that the total of uncorrected and undetected misstatements would result in a material misstatement of the financial statements. So, what that is saying is that I need to set a filter for my test work at the account level that's going to allow me to detect misstatements such that if there are misstatements in that account that I don't detect from my procedures, that the likelihood of the sum of those being greater than my overall materiality amount is really small. And so when we set tolerable misstatement, it's going to be derived from materiality, from planning materiality, that overall materiality amount. It's always less than that amount, usually, and this is based on judgment, between 50 and 75% of that level. So let's say our overall materiality level is $10,000, then tolerable misstatement is going to vary between $5,000 and $7,500 depending on the account. And that account to account judgment is based on what we know about that account and how risky it is, and maybe the controls that are around it. And we're going to talk more detail about that when we're together in class. So this is where I think this is more complicated than just the idea of overall materiality, because now we're taking that amount and we're breaking it down and we're applying it to accounts. And something that's really important for you to keep in mind is that the sum of our tolerable misstatement for each account, when we add it all together, is going to be greater than our overall overall materiality amount. And so if I set tolerable misstatement to be 50% of overall materiality for cash, and 50% for accounts receivable, and 50% for inventory, if I just take those three balance sheet accounts that I have set tolerable misstatement for, I'm already at 150% of planning materiality when I add those three together. Okay, so at the individual account level, they're less than planning materiality, but in sum, I'm already at 150%. How is that? Why do we do that? Well, the reason for this is there's some logic behind it, but also efficiency is a part of it too. But the first is that not all accounts are going to be misstated by their full tolerable misstatement amount. So it's unlikely that cash would be misstated by 50% of planning materiality, that tolerable misstatement level. So that's the first reason. It's unlikely. The second reason is that audits are conducted all at the same time, right? So you have an engagement team, and somebody's working on cash, somebody's working on inventory, somebody's working on the liabilities, somebody's working on revenue, somebody else is working on expenses. And so because the teams are working simultaneously, they need to have a working materiality level. Now, if one person was doing the audit and they were moving through those balance sheet accounts and those income statement accounts one by one, in theory, they would know what each account was misstated by or not, and they could just take that overall materiality level and move it along with them. But because we don't have that, we have multiple people working at the same time. We need to set a tolerable misstatement level at the account level, and then each auditor can work with that and then talk about what they've found. The next reason that we allow the sum of tolerable misstatement to be greater than overall materiality is that when you take tolerable misstatement and you compare it to the account balance, so let's say for Walmart, for their inventory, they're going to have really large amounts of inventory. Well, the likelihood of that tolerable misstatement, even if it's set at like 75% of overall materiality, that relative to the final account balance is probably a pretty small percentage, single digits for sure. And so it's going to be a fine enough filter that if it is going to, if there's a misstatement there, it's going to catch it. Um, and then the next reason is that when we find a misstatement, it's not like, oh, here's a misstatement, let's correct it. No, we stop, we start asking questions, and we do extended procedures. So I do not document that I found a misstatement, ask the managers to correct it and move on. No, I have to dig deeper and see if there's another misstatement that might be in the account, and I'm trying to figure out why the first misstatement even existed. And then finally, materiality is just a safety net. So when I find a misstatement, if it's not material based on my tolerable misstatement, so it's below my tolerable misstatement threshold, I don't deem it something that management needs to correct. I still have to document that I found it. And at the end of the audit, we're going to take all of those uncorrected misstatements. Okay, so it's below my tolerable misstatement level, meaning I don't have to ask management to record a journal entry. I'm going to look at all of that together, and I'm going to make sure that the sum of those uncorrected misstatements do not exceed my overall materiality level. So if I've set my filter fine enough, I'm going to catch what I need to catch such that the sum of those uncorrected misstatements are not greater than overall materiality, and my financial statements are fine. If I find that they are greater than my overall materiality, then I need to ask management to make some journal entries to correct the misstatements that I have found so that the financial statements are materially misstated. So this is tolerable misstatement is something that allows us to set the scope of work at our account balance level, to make judgments when we're in the thick of procedures, to determine whether something that we find is a problem and whether management needs to fix it, or if we just need to document it and evaluate it at the end of the audit in conjunction with all of the other potential uncorrected misstatements that might be found. But hopefully there aren't very many misstatements. That's what we always hope for, but to plan for them appropriately and to be able to evaluate them appropriately when we find them, we need to set tolerable misstatement at the account level. Now, like I said, this is complicated, and I expect that you have questions about this, and so if you do, that's good. I want you to bring them to class because I expect us to talk about this more because it's a fun topic and it's an important topic for you to understand.